Hey, what's going on, guys? It's Leo. If you aren't subscribed, please go ahead and subscribe, like, and share this video. So let's go ahead and dive right in. So we're going to do something a little bit different. We're going to talk about game theory. And for those of y'all that aren't aware, game theory is essentially a theoretical framework for social settings where there are competing uh, people, basically. So there's game theory for games, essentially. I mean, that implies it with the name, right? But essentially, what it is that if you can play game theory optimal, meaning that any mistake your opponent makes, you are going to be profitable from it. And so we're going to take a look at that from an AMC's perspective. I think I've figured out exactly what the hedge funds are thinking. Hedge funds are very much so aware of game theory, and that's how a lot of them think. At least the high level thinkers think in terms of game theory. So, first, I'm going to have to explain the prisoner's dilemma, and then I'm going to have to go into the hedge fund dilemma. So, what the prisoner's dilemma is the police arrest two people for some petty crime, but they suspect them of having committed a much more serious crime. But they don't have any proof of this other crime. But the police, they want to get a conviction on this really bad crime that they have done. So they take the two prisoners, they separate them, put them in two different rooms, and they try to convince them. We want you to turn on your accomplice. If you give us proof that he did this bad crime, we will let you go free. We'll waive the charges of your smaller crime where you do a year in prison, and your partner will do 10 years for the more serious crime, but you're going to be off scot-free. Now, the possibilities with the prisoner's dilemma are going to be that I'm just going to call them John and Jack. So John stays silent, but Jack folds, meaning that the other one would go to prison for 10 years and the other one gets off scot-free. And then the same thing in reverse. Jack stays silent, but John folds. Third outcome would be that if both stay silent, they do 1 year in prison for a small crime. But the problem is that when John is over here in this room, he doesn't know what the other guy is thinking. He's wondering, is he going to turn on me? Is he going to turn on me? And so he's panicking and he's worrying about, what if, I get turned in, right? So that's going on in their mind because they're separated. But if they both stay silent, they do 1 year for the small crime. If they both fold, then they both do 10 years in prison. So what's interesting about this is that it puts a lot of stress on their minds, because if this other person turns me in, then I go to jail for 10 years. But if I turn them in, nothing happens to me. So people typically will act in the best interest of themselves. And the worse the outcome, right? 10 years, it makes it more likely they're going to turn. So let's say that it's a parking ticket. They're less likely to turn on their friend if the risk is much less. But if the risk is higher, like for example, if I said that, well, I'm going to burn you alive if you don't turn in your friend, they're very likely they're going to turn in their friend. So it's just important for you to get a little bit of an understanding of this so that I can go ahead and explain what I think is going on with the hedge funds. So the hedge fund dilemma is a little bit different. Let me see if I can, let me zoom out. So there's X amount of funds short, right? So in the prisoner's dilemma, you have two people that are arrested. It gets more complicated because we don't know how many hedge funds are short, right? Could be, we'll just say 10 for this argument. So you got 10 hedge funds that are short, right? So they can talk, but it doesn't necessarily mean that they can trust one another. And if you're the first one to cover, you might survive, is essentially what this boils down to. So the possibilities are the price goes down, which gives a increased probability that a certain amount of funds will cover, right? So as the price goes lower and lower and lower, and it is getting closer to their average short price, right? So their loss has come down. Maybe they can get out of break even, right? Maybe a small profit, right? That's going to increase the likelihood of those funds wanting to exit, get out of this trade. I'm done with it. Um, the other option would be the price goes up, increased probability that X amount of funds are forced to cover by their brokers. 3 would be all continue to hold and time forces them to cover, but time won't force them all to cover at once, meaning the first ones out might survive. So that still has that same pressure of, I need to be the first one out of this thing. So what I mean by time forces them to cover is that it's costing them to hold, right? It's costing them money to continue to do this. So that's reducing the amount of collateral they have to hold these positions. And it puts pressure on them. There's also the stress of them worrying about if other funds start to close before me and I get screwed, I get caught in this thing. So fourth option would be that all fold at once and force MOAS, nobody survives. I think that's probably the least likely of all of these. And the fifth, and I think this is what Ken Griffin or Citadel is planning, is to find a Nash Equilibrium. Now, a Nash Equilibrium states each player's strategy is optimal when considering the decisions of other players. Every player wins because they get the outcome they desire. I think that Citadel is aware of the almost religious following within the ape community that they are not going to sell. I don't think they're idiots. I think that they're very much aware that the apes aren't willing to sell. And I think that the hedge funds are in a position where there's no way out for them except to find Nash Equilibrium. So the question is, what is Nash Equilibrium? Well, let's take a look at what they've done recently. We've seen the price get beaten down, right? So my first thought is, well, if I'm at the top of all this and I want to beat down the price, why am I doing that? Well, one, it's going to reduce my the pressure from my brokers, my prime brokers, telling me that I need to get out of this trade because I'm underwater. It's going to give me a little bit more breathing room, essentially. So we've seen that. Also, with them coming out and restricting investor withdrawals, that's another thing. That's more confluence telling me that it seems like they are having liquidity issues, that they are running out of collateral. So now that gives us kind of a top framework. So let me see if I can pull up. Right. So they don't want it up here because this is where their brokers start to pressure them into, you need to get out of this trade. This is you're really underwater. But then again, they don't want price to come down here because this is where it starts getting really tempting for other funds to start closing their positions, right? I'm just going to I'll just make it red. That'll work. So what I think he's trying to do is he's trying to buy time within an area that's acceptable, right? It's not low enough that the other funds are wanting to cover yet, and it's not high enough that he's having those liquidity issues. But if we stay within a range here and he buys his time, now why would if I'm at the top of all this, why would I want to be buying my time? How can I survive? Because if this thing goes through, I'm done. Boom, gone, right? I'm not going to be able to convince the apes to sell. And to be honest, I don't even want them to sell because if they do, and I end up buying back those shares, it's going to force this thing to go up. So there's really no way out except if I can bide my time and I can wait for a market crash. If we look at margin debts and just debt in general, the economy goes through debt cycles, right? So people become over leveraged in debt across all different markets, assets, not just when it comes to trading, but people become over leveraged because they buy houses they can't afford. They max out their credit cards. And when interest rates start to go up, that puts more pressure on them because that increases their monthly payments. People start to default. Debt in the US is at all-time highs. And I think he's aware of this. So I think the Nash Equilibrium outcome is that he waits for a market crash that isn't necessarily caused by the AMC squeeze. Now, what that would do is that would give him the option of blaming this whole thing on the market crash, right? So now why would I want to blame it on the market crash? Well, because if I can move public perception towards away from me, away from the criminality of the things that I've done, then I can convince them to give me a bailout and I survive. Maybe all the hedge funds survive. That's what I think they're going for. I think they're trying to bide their time for a general market crash that they can blame this on so that they can convince Congress to give them a bailout so they can survive. Because I've been sitting here and I've been thinking, well, it doesn't make sense. If they're trying to force this thing down, it's not going to zero because the company's not going out of business. And if they could do that, they would have already done it. So that's not an out. If it's about forcing it down lower, well, that doesn't make any sense because the lower it goes, the more likely that smaller funds are going to want to cover, which is going to end up forcing the thing to go up, and I go bankrupt because, well, now the squeeze has happened. I can't have it going up more because if it goes up too high, then my prime brokers are pressuring me and all the other funds to cover. So it seems to me the most likely scenario, the Nash Equilibrium scenario, is that they hold out until a market crash, which I think is coming very soon. The hedge funds end up getting what they want because they get bailed out and they survive. That's what I think it's about for them, is surviving this thing. The apes end up getting what they want because they get paid because the squeeze still happens. It's just they use the bailout money to cover it. And then it's over. I think that's the most likely scenario from a game theory perspective. I think that's the most likely scenario. Because I don't see a way out for them. If we are correct in that, they have these massive short positions like they do, there's really no way out. There's just not. It's not like they can, they have to cover, which is buying pressure, which would force up the price, So I don't see a way out for them. I don't. And I've been going over this over it and over it, and I think this is what they're planning. I think that it's they're going to blame it on the market and the market crash. They're going to get a bailout. They're going to survive and keep doing the stuff that they've done. Look at it back in 2008 with the mortgage-backed security crisis. History rhymes. It's not the same exact thing, but it's very similar. And what happened back then? They got their bailout. They survived. I think it's the same thing that's happening. Anyway, that's going to be today's video. Not much has changed from yesterday. We're just kind of waiting. If y'all have any questions, drop them in the comment section down below, and I'll talk to y'all soon.